Does revenue equal profit? Many people use the terms revenue and profit interchangeably, but they are not the same thing. Understanding the difference between revenue and profit is essential for business owners, investors, accounting students, and anyone interested in how companies operate financially. While both are important financial metrics, they measure very different aspects of a business's performance. Revenue is the total amount of money a company earns from selling its products or services during a specific period. It is often referred to as the top line because it appears near the top of a company's income statement. Revenue reflects the amount of business activity taking place but does not consider the costs required to generate those sales. For example, imagine a small electronics store sells $500,000 worth of products during a year. The $500,000 represents the company's revenue. First glance, this may seem impressive, but revenue alone does not reveal whether the business is actually making money. Profit, on the other hand, is the amount of money left over after all business expenses have been deducted from revenue. These expenses can include inventory costs, employee salaries, rent, utilities, marketing expenses, taxes, insurance, and many other operating costs. Profit is often called the bottom line because it appears at the bottom of the income statement. Using the same electronics store example, suppose the business generated $500,000 in revenue but spent $420,000 on inventory, payroll, rent, and other expenses. In that case, the company's profit would be $80,000. This means that while revenue was $500,000, the actual earnings retained by the business were only $80,000. This example demonstrates why revenue does not equal profit. Revenue measures total sales, while profit measures financial gain after expenses. A company can have high revenue but very little profit if its costs are too high. Likewise, a business with lower revenue may be highly profitable if it manages expenses efficiently. There are also different types of profit that businesses track. Gross profit is calculated by subtracting the direct costs of producing goods or services from revenue. Operating profit goes a step further by subtracting operating expenses such as salaries and rent. Net profit is the final amount remaining after all expenses, including taxes and interest, have been deducted. Investors often pay close attention to both revenue and profit because each provides different insights into a company's performance. Revenue growth can indicate increasing demand for products or services, while profit growth suggests that the business is managing its costs effectively and generating sustainable earnings. A company that focuses only on increasing revenue without controlling expenses may struggle financially. For example, aggressive discounting can boost sales and revenue, but if profit margins become too thin, the business may still lose money. Successful companies aim to grow both revenue and profit over time. Financial statements help business owners monitor these metrics and make informed decisions. By analyzing revenue and profit together, companies can identify opportunities to improve efficiency, reduce costs, and increase overall profitability. Revenue does not equal profit. Revenue represents the total income generated from sales, while profit is the amount that remains after all expenses are paid. Both are important measures of business performance, but profit provides a clearer picture of a company's financial health and long-term sustainability. Understanding the distinction between the two is a fundamental step in financial literacy and business success.